Hello, and thank you for joining us on today's webinar on the results of our recent Global Treasury Benchmarking Survey provided by Reval and Treasury Strategies. I'm Grace Kwan, Marketing Program Manager at Reval, and on behalf of all of us at Reval, I'd like to thank everyone for joining today's webinar. If you need technical assistance, use the chat panel on the right-hand side of your screen to send a message to the host for assistance. You may also call the WebEx Technical Support line at 866-229-3239. Before we begin, I'd like to go over a few tools you will be able to use throughout today's webinar. To submit a written question during the event, locate the Q&A panel on the right-hand side of your screen, type in your question, and click Send to submit your question to all panelists. Your questions will not be viewable by other attendees and will be addressed at the end of the presentation. As a reminder, today's session is also eligible for 1 CPE credit. Under NASBA regulations, you must remain on the webinar for the entire duration to qualify for the credit and complete the post-event survey following the webinar. Certificates will be distributed via email. Finally, please note that today's webinar is being recorded and the recording and presentation slides will be distributed to all participants next week. Before we begin, I'd like to introduce our speakers for today's webinar. We have with us Justin Brimfield, Chief Marketing Officer at Reval, where he focuses on corporate strategy and strategic marketing initiatives across the global organization and is responsible for market research, pricing, brand management, digital marketing, advertising, public relations, and social media. Since joining Reval, he has been instrumental in helping the firm deepen its penetration in the North American corporate risk marketplace with the 2009 acquisition of FXpress and broaden its addressable market and global footprint with the acquisition of EcoFinance in 2010. We also have with us Kathy Gregg, Partner and Director at Treasury Strategies. In this role, Kathy sets the firm's strategic direction and manages senior client relationships. Her guidance has helped improve strategies and operations for the corporate treasury and banking sectors. She has focused on payment systems and banking industry evolution since founding the firm in 1982 and is currently leading the firm's advances in the treasury technology space. Kathy has been a vocal advocate for client interests in regulatory matters, speaking to the U.S. Senate Banking Committee regarding the Volcker Rule, and authoring numerous papers on the financial collapse, money fund regulations, and the impact of regulatory change on U.S. liquidity markets. Thank you, Kathy and Justin, for joining us today. And without further delay, I'll hand it over to Justin to begin today's webinar.
Hello, everybody. Thank you for joining us today. Some interesting insights that we're going to go through. I hope you find them as interesting as we did in the survey results. So a few things that we're going to talk through today. The first is really around the challenges that we see or that you see in driving change in Treasury. You know, the second being around just the scope and structure that apparently the market forces are impacting and requiring Treasury to adopt and adapt to. And then the last, how technology is playing a role and enabling the ability to address those changes. So just some insights on the survey. So this is one of the largest surveys that I've certainly ever sponsored and been part of. So it's great to see the responses. So we had over 600 Treasury responses around the world. You can see the global distribution of EMEA, APAC, and the Americas. Major contributors to this, to get such a far-casting net of insight is really the partnership with the European Association of Corporate Treasurers, Treasury Strategies, and Reval. So the results that you see here have been collected over end of 2014 into 2015, and hopefully you find the results as enlightening as we have. So regarding some of the top insights that we'll talk through today, you know, the first being the challenges in Treasury. So we're seeing significant pressures on corporate liquidity, and a lot of this is really around cash visibility, which I'll get into in just a few minutes. You know, the second would be really around the rules and regulations and this ever-changing environment that we operate in, and the different regulatory bodies and banking bodies that impact our ability to be effective in what we do in Treasury day in and day out. The ongoing discussion of really Treasury as a strategic partner to the business and what that looks like and how that's changed. And then lastly is the trend around resourcing and really the impact of of technology on resourcing. We'll then get into some of the changing scope and structure and talk about technology as an enabler. So this is very much consistent with what we see, although I think the numbers don't lie. It's interesting that only 20% said that cash and liquidity is not the top priority for corporate treasury challenges that are being faced from a risk perspective. You know, the other being FX, and then the third being counterparty risk. So let's talk about the cash visibility just a little bit. You know, emerging markets are not so much emerging anymore. They're actually an impactful cash source for us, and having visibility and understanding those businesses and how they're actually driving and throwing off cash that can then ideally be used is a major source of pain and a challenge. Whether that be China, whether that be Brazil, we do see the inability to tap into that cash as being a real concern. And then it comes to the timeliness of information. So not only does it have to be accurate and complete, but it has to be timely. And then the third element here is really, you know, in the corporates that we talk to, and what they're looking from a vendor perspective is to have some sort of a tool or solution to pull that together, to really have a global view and understand how that cash and the risk associated with that we can then provide guidance to how we can mitigate the risks posed by this effective liquidity management. So, you know, the second area is really around FX volatility. So the big challenges there that we're seeing from our clients is really the exposure to increased volatility. And a big element of that is the devaluation of the Chinese currency and the euro, and how that impacts companies across industries. You know, one thing that we're seeing from our clients is how they're looking for more natural hedges, you know, to offset, you know, their multi-asset class risk that they're feeling. The third element here is the changing environment and this low to negative interest rate environment that we're facing. We're seeing clients really reevaluating their banking relationships to diversify counterparty risk. That's been something that's been going on for some time. It's one of those trends that pre-global financial crisis organizations went through and really wanted to centralize around a core set of global banks, you know, collapse down banking structures and try to get as much as they can out of few. Post-global financial crisis, they've gone and looked at really diversifying even further to make sure that they don't have concentrated counterparty risk. You know, we're still seeing that, but not the move isn't quite as aggressive as it had been. But the thing that's really impacting them is the backdrop, and this, you know, quantitative easing stopped, you know, about a year ago. We've got the Fed draining liquidity on the balance sheet, and we've got increasing interest rates. If that's not enough, we've got the banks that are reevaluating their businesses that they're in and the way that they work with their clients under Basel III. So certainly a challenging backdrop. You know, so then we step into what are the top three regulatory challenges, and so Dodd-Frank, EMIR, Basel III, and IFRS kind of win the day. I guess IFRS tied with 9, 13, and then 157, all tied for third. You know, in looking at this, it's been 5 years, I guess, since Dodd-Frank was passed, July 21st, 2010. So this rule, these laws that have been put into action, they don't seem to necessarily have made things easier for the corporate treasury. In fact, working with our clients, many of them are still struggling with managing the requirements associated with Dodd-Frank, and there's lack of consistency regionally. Our clients in certainly in North America, the U.S. have given a little bit of a stay of execution where, you know, you've got to comply, but we're not going to police you. And our clients in Germany certainly feel more of the, you know, you must report, you know, both on the bank side and the corporate side. So So we're seeing, we're seeing companies still struggling with the impacts of Dodd-Frank and EMIR. Bank relationships are changing. We are seeing banks under Basel III really going client to client and reevaluating the share of wallet with each client and determining whether that meets what they're looking for out of that specific relationship, and then adjusting accordingly. One thing that I will say is when Basel III first started to impact the corporates, Treasury Strategy came out with I think an exceptional forward-looking study on how corporates could essentially best arm themselves with this conversation that's coming from their banking partner, and through more active and proactive forecasting, more effective forecasting, to really be able to prove that, look, I'm not a risk to you, bank, for the cash that you have to have on hand for operating versus non-operating. I have good forecasting. I have the ability to really understand and have tight management of my forecast. Really allows for a more effective conversation and more trust in that there's no need to increase my rates. I know what I'm doing. One thing that's not on here that I found interesting, and I learned later that it was something that apparently we didn't ask, but one thing that's not on here that is FBAR reporting. Even though it's easy from a subject matter perspective, companies that we talk to still are very challenged by it. So the question of how strategic is Treasury is something that has been consistently asked over the last 10 years or so, since Treasury really did step into the forefront to have a bigger voice within the organization. If you look at the 4 risk categories, whether that be operational, regulatory, financial risk, or strategic, only 13% cited strategic as most critical, which I thought was interesting. If you look at the top 3 strategic challenges, the first one at least, it really is around cash forecasting, cash visibility, and financial risk management. And when you look at that, cash forecasting is where Treasury departments are outward facing. This is an opportunity to add real strategic decision-making value around, whether that be funding and acquisition, whether that be investing in the business in some specific way, or best way to fund operations, or how to reduce borrowing costs. So the strategic value that Treasury can have on the business is significant, and it seems that cash forecasting is still looked at as that top way that organizations and Treasury, the Treasury organization, can impact that. So then the last I'd put here is that Treasuries are focused on these operational challenges. So if you don't have visibility, you can't forecast. Without that visibility, you cannot protect the company from risk and unexpected costs. So it's not a real surprise that cash visibility is a close second to cash forecasting. And then risk management is something that really permeates throughout the organization. One area that I didn't see on here that I would have expected to see is really around intercompany lending. So, I assume it's somewhere there among the different answers. Maybe it's blended into the others. We see companies struggling to manage cash forecasting, global cash visibility, and global risk management. And then the intercompany, mix management. Mixed because trying to find out the right balance of pooling and in-house banking and intercompany loans, multilateral netting, and payments received on behalf of are certainly challenges that come under that intercompany umbrella. So the findings here I thought were quite interesting. You see that big spike on the left around reviewing policies and procedures. How are you addressing today's challenges is the question. And the first thing that thrifty Treasury professionals working under a cost pressure environment do is to look at current processes, policies, and procedures and structures, and that will only get you so far. Before then you go to number 2 and 3, where you then say, okay, now that I've tightened up my shop. I'm doing things as well as I think that I can. Now, how can I operationalize that with either existing technology or new technology? So under that first line of defense, it's really collaborating with other Treasury professionals around best practices, whether that be user conferences, internal or external, to understand. Budget is a roadblock, and what we found in the conversations that we have is you need to build a business case, and Treasury are not traditional technology buyers. A Treasury professional in their lifespan may purchase or subscribe to 2 or 3 Treasury solutions over their time, and then a myriad of other support solutions that help them. So what we found is organizations are not best served going in with an operational efficiency business case. We've found that the strategic and the control value and the risk value that is put behind the business case generally stands up a heck of a lot better than going in just with the operational efficiency, because the organization tends to believe that you've already gone through that. I think Kathy's going to talk about this in a little bit, but what we have seen with our clients is we don't see a decline. We have to do more, but it's not necessarily with less. We've seemed to hit somewhat of a floor where we're not necessarily cutting anymore from a resource perspective.
Okay, so good morning, everyone. I'm Kathy Gregg. Thanks for joining us. And now we're going to turn to the second grouping of our findings, which deal with Treasury's changing scope and structure. And I think some of the findings in this section are particularly interesting because it gives us a chance to see some possible macro trends in Treasury that are a little bit difficult to observe from the ground floor in the middle of just my own Treasury day after day. So we're going to talk about the size, the structure, and the responsibilities of Treasury and how those are changing. So if we turn to slide 11, we'll discuss responsibilities first. So in the survey, we began by asking a very simple yes-no question. Do you think Treasury is a key contributor to the success of your business? And overwhelmingly, the answer to that is yes. 92% of the survey respondents believe that to be the case. Just incidentally, kind of wonder what's going on in the other 8% of companies who think it's not a key contributor to business success, but we'll focus on the 92%. And as this graph on page 11 shows, looking into the future, about 2/3 of companies think that that contribution is only going to increase over time. So we have a very good, positive vision and direction in Treasury currently. One of the things we were interested in, we have this expression in Treasury, lots of us repeat it often, and that is Treasury's always being asked to do more with less. So we wanted to examine the first part of that expression, the doing more, and see if Treasuries really are being asked to do things beyond the quote-unquote typical Treasury functions. And we found that that was absolutely the case. 75% of companies in their Treasury handle at least one function that isn't a core Treasury function. And these most commonly include supply chain finance activities, insurance, commodities, pensions, and sometimes even sales-related activities. In addition to that, 2/3 of all of the companies expect their scope of responsibility in Treasury is going to increase in coming years, and none of them say the scope is going to decrease. So this also paints sort of a macro picture of Treasury as a function inside the company that is increasing in responsibility, is going to continue increasing responsibility, which to us says there's a good mandate here for increased relevance and opportunity. All right, Next, we're going to go to the size of the Treasury teams. This is always a perennially interesting subject for people because everyone always wants to know how the size of their Treasury stacks up against, I don't know, the ideal or the average or whatever. And this chart is a little bit difficult to decipher quickly, so I wanted to spend a minute laying it out before we get into the findings. So on the horizontal axis of this chart, we're showing the size of the Treasury, the global Treasury team. So is your global Treasury less than 5 people, 5 to 10, 10 to 20, or more than 20 people? And then the colors of the bars relate to the size of the company that's responding. So the darkest green bars are companies with less than $1 billion in annual revenues, going to the lightest bars, which are companies with more than $20 billion in revenue. And what you see here, first of all, is something that everybody would expect, that the smallest companies are typically the ones that have the smallest treasuries. But there are some nuances in here that are kind of interesting. So if you are a company whose revenues are less than $1 billion, the vast majority of you have fewer than 5 people in your Treasury group. If your company is $1 to $10 billion in sales, 3/4 of you would have less than 10 people in your Treasury group. If you're a company between $10 and $20 billion, there's quite a bit of dispersion in the size of your Treasury groups. Frankly, you could be of any size whatsoever, but 42% of you in that size range have more than 20 people. And if you're one of the largest companies, over $20 billion, the majority of you would have more than 20 people. 57% of you have 20 or more people. I find it just a little curious, I'm not sure what to make of it, that actually some of the very largest companies also have less than 5 people in Treasury. And I just have a hard time getting my mind around how a firm of that size can actually operate an effective Treasury with so few people. But it may be that there are some firms, even though they're large, they are simply not complex. They are not terribly global. They don't have multiple lines of business. They don't operate with very many currencies. So again, even though they're high in revenue, the lack of complexity might make it possible for them to run well, at least with few people, but it still seems like an oddity. We also talked in the survey about how people perceive the size of their staff changing in coming years. And here's where we get to the other side of that expression, doing more with less. Are we really still being asked to do the less part? And I think the answer to that may be we're through that stage. A decent number of firms foresee staff increases in coming years. 30% of all firms expect that their Treasury staffs will increase in the next 3 years. This is slightly more true for U.S. companies than European companies. 37% of U.S. companies say their staffs will increase versus only 26% of Europe. But still, that's a reasonable number of firms. And a much smaller number of firms, only 12%, foresee that their staffs will be shrinking. So I think that that is a very good bit of news for us, that it's not now any longer more with less, it's just more. Okay, moving on to slide 13. We want to take a look at the structure of Treasury. And I think we've got some really, really significant findings here. Again, at the macro level, this becomes much more interesting. So here we're asking a question about how the Treasury is structured. Primarily, is it centralized or decentralized? And if it's centralized, is it fully centralized, actually everything in one place? Or do we have regional Treasury centers or regional Treasury activities? And so when you add together the leftmost 3 bars on this chart, I mean, the trend of centralization is absolutely inescapable. 93% of our survey respondents describe themselves as centralized or centralized with some regional activity, and only 7% call themselves decentralized. This, I believe, is in quite stark contrast to what we would have seen in answer to this question about 10 years ago, when you did see quite frequently, especially among large companies, autonomous treasuries outside the company's headquarters country. So that's a trend that really seems to be well established now, this centralization. Over 40% of companies think that in coming years they're going to get more centralized, and very few would say they're going to get more decentralized. And this is at the same time that many companies believe that their overall corporate footprint is going to grow globally. So the company becoming increasingly global, and yet Treasury becoming increasingly centralized. So what does this mean? I see here that we have completed, in Treasury, we've completed a transition to having decision-making and control in a single location for the whole worldwide organization. And I believe that this was a necessary transition in order to support the complete real-time visibility of positions and exposures globally. You can't do that very well if you've got lots of pockets of regional autonomy. You have to have that central decision-making and control. And if you're going to have globally consistent applications of controls and securities, similarly, you have to have a single place calling the shots. We actually hear this confirmed in many of our global corporate consulting engagements, where at least one of the objectives or some of the objectives in those engagements are to finish the process of standardizing reporting globally, of standardizing processes, important Treasury processes globally, and very significantly, to standardize the use of technology globally. It wasn't very uncommon, even a few years ago, that the Asian Treasury people were on one platform and the South American people were on another and the European people were on a third. And that is being centralized very strongly. So this in particular is one very profound kind of macro trend that I think is telling us something about very important about Treasury. All right, so in summary, in this section about the structure of Treasury, we're seeing a broadening of responsibilities that's expected to continue, 2.5 times as many firms expecting to grow their Treasury as opposed to shrinking, and what may be the end of a very strong move to centralizing the Treasury function, augmented by regional centers and activities as appropriate. Okay, and now we move to our third set of findings that have to do with technology itself and how it's really enabled some of these changes for Treasury. And we're going to talk about the state of Treasury technology, what it is we're using, what kind of tools we're using most predominantly, and the way those are being deployed, how old it is and the consequences of that, and what are some of the obstacles to using more Treasury technology. So turning to the next slide, where we first want to get a look at just what companies say their primary Treasury tool is. They had to pick one, couldn't have more than one in this question. And what we see here, I think I'm very gratified by it. As their primary type of tool, 3/4 of companies say it is either a TMS, an ERP, or some kind of combination of specialized platforms. And only about 1/4 of them, 27%, say their primary tool is spreadsheets. And I find this gratifying simply because I think that the migration away from spreadsheets as a primary tool is an indication that Treasury and Treasury technology are fully coming of age, that the value in Treasury-specific platforms has been realized. I mean, we still have more ground to cover, but the move away from spreadsheets is certainly very, very positive. In this question, we see big differences depending on the company size and the geography. And I'll cover some of those because they're sort of interesting. So with respect to spreadsheets, very curious, you see this as being twice as common in the U.S. as in Europe. 43% of the U.S. respondents said spreadsheets were their primary tool versus only 19% of the European respondents. And as you might expect, it's much more common to be the primary tool for smaller companies versus larger companies. The TMS systems, only 30% of the smallest companies name this as their primary tool versus nearly 60% of the largest. Again, that's sort of what we would have expected. Interestingly, the use of ERP systems is, I think we would have expected it to be relatively low. I'm not sure I thought it would be this low, but it's actually lowest in the very biggest companies, which isn't what we would have thought we'd see. Of the companies greater than $20 billion in revenue, only 6% of them say the ERP system, the ERP Treasury module, is their primary Treasury tool. And also, counterintuitively, the ERP is the primary tool less often in Europe than in the U.S., which we would not have expected to see because European adoption of ERP systems overall was ahead in Europe compared to in the U.S. Only 9% of European companies name ERP system as their primary technology versus 12% of firms in the U.S. So those were just sort of surprising and interesting. In addition to talking about the primary tool, we also wanted to get some information about the overall set of tools that treasuries are using today. And we developed this very interesting fact that on average, the average treasury uses 3.3 different technology tools. So maybe historically, we would have thought companies wanted to buy a treasury management system or use an ERP and have that do everything for them. But if on average we're using 3.3 different tools, it seems like that's not the case any longer. Some of these other tools, well, of course, in addition to your bank platform, which is one tool that many companies name as one among their tools, also FX trading portals, tools that do trade confirmation, tools to support bank account management, going to that FBAR topic that Justin mentioned, tools for hedging, risk management, collateral management. So I find this really fascinating.
Yeah, Kathy.
Yeah, go ahead.
Oh, sorry. I was just going to say that we see this in real time. I can tell you that we've got a portfolio of different partners that we call it our straight-through processing community, and made up of many of the functions that you just referenced. And on average, again, this is taking into account mid-market companies all the way up to Fortune 10. On average, we see at 80% of our clients taking at least one of our partner community on as an integrated partner. So this 3.3 really doesn't surprise me, but it's good to illuminate.
And I think it's an area that bears watching because it may be we're at the beginning of a trend here and we're going to see it rise. We're going to see more tendency to use one primary solution and several sort of point solutions for very specific needs. If that's the case, it's going to have interesting implications for the kind of people we want to hire into Treasury in the future. I mean, if we're integrating several systems to run Treasury, well, first of all, we're going to have to deal with interface and integration issues, which really are high on people's lists of some of the thorniest things they deal with in their technology, and the kind of technical skills we're going to need to look for. It kind of raises the bar in that area. So I think it's fascinating. It's going to be something to watch.
And frankly, I think it's something that challenges the vendor community. In the end, Treasury professionals, from my perspective, just all they want to do is really remember their password, right? They don't want to have to worry about integrating system A to system B. They don't want to have to worry about chasing down technical resources internally or externally to make something work again that ideally once worked at one point. So I think it really drops the challenge down to the vendor community to service these lean but perhaps expanding treasury groups and their support structures around them. So interesting trend indeed. Just getting into, one of the questions we asked I thought it's always a fascinating one for me is when was the treasury management solution implemented? And if you look at the breakdown here, so it goes from most current to the far right all the way back to the far left. You can see even kind of post global financial crisis a step up, however subtle, in the use of or implementation of the current treasury solution that's in place. What I really find a stark indicator is the far left is that before 2010, so 5 years ago was the vast majority of these systems were implemented. And so as somebody that is responsible for strategy and looking at markets and understanding churn rates and all of that, historically we had put out that treasury professionals, it looks like every five or so years, pick their head up and they say, all right, maybe it's time to take a look. It's clearly longer. It's clearly that, and we understand why. I mean, organizations come in with the best intentions, and they're looking at their problems at that time. And some instances they'll look out maybe a year, maybe 2 years out at what their needs will be, and then make buying decisions. One trend that we do see that will certainly impact that is really the trend that we've seen in other places. The majority of these solutions are installed. This legacy install base where companies are under pressure, both IT departments and Treasury, to most effectively manage their technology stack. I was at a resource company in Canada not too long ago, and I was supposed to sit down with the treasurer, and he was called away, but they said, the CIO is really interested in talking to you, the CTO is interested in talking, would you still like to meet? And so sat down, and it was fascinating, the conversations that we got into. He had only been there for less than 12 months, and he referred to a number of the resources that he had inherited, a team of about 30 people, as server huggers. And I thought that was an interesting way to describe the team. And he said historically they had been focused on just making sure that the machines were humming. He's a bit more forward-looking, and he's transitioned his team into focusing more on relationship management, managing third-party outsourced IT relationships, whether that be for hardware or software, and so that's where he sees the trend going, and certainly we've seen that in other industries. So, the customer relationship management space has certainly gone through this, where legacy technology has been replaced with the likes of Salesforce and things of that nature. Human capital management and the HR space has been another one that we've seen go through this trend of moving from installed to cloud or software as a service technology. Likewise, and we're seeing it now in ERP. Many of our clients are coming to us and saying, as part of your partner STP partner community, do you work with SAP or Oracle Cloud? And it seems like that trend is impacting. Kathy mentioned earlier on an earlier slide this move to centralization. The centralization theme is driving much of the upgrades or updates that we're seeing that are on the rise, and most of the criticism is lack of integration. I touched on that, and the onus really should be put back on the vendors that are part of the the organization's treasury workflow to ensure that the systems work together, and ideally even the support of those systems work together. What's encouraging as a vendor is to see that only 22% report no limitations with technology. So in the past, if you think back to 5-10 years ago, I've been in the space for a bit, it was almost a little bit of a Frank Sinatra tune. Treasury, they want it my way, meaning I don't care what others are doing as much, but I need to replicate this report exactly. I need to have this specific workflow to the T. What we're finding now is people don't want customized treasury solutions. They really want, flexibility and configurability, but they want to ensure that the longevity and the support associated with the infrastructure or the solution is spread out over a number of companies, not necessarily just the MyCorp way, but rather built on best practices and being leveraged, across a broader client base. So certainly some interesting findings on that.
Justin, one other finding, it wasn't on our graph, but I found it really interesting. One of the other big comments in the survey about the limitations on their technology was not that the technology was limited, but that it hadn't been fully implemented. Mm-hmm. So almost 30% of our respondents said that was an issue with their technology, which I just find, that's such a problem that can be addressed. So, all right.
Yeah, and that actually, just on that, Kathy, that speaks to a change in buying that we're seeing. So it once was, I'm buying this, I need to buy as much of a license as I can because I get budget for it in this big lump, and if I don't get it in now, so you'd find these organizations that would really put everything under the moon inside these requirement documents and then buy a bunch of technology and then either run out of funds to implement or just get fatigued and not complete the process. One trend that we're seeing now that it's less of an install license purchase, it's more of a subscription model that's in the marketplace today, is organizations are buying according to their pain, and it really puts the onus back and the responsibility back on both parties to say, okay, we're going to get through phase one, and unless we both perform exceptionally to phase one, we'll not get to phase 2, 3, or 4. So it's a great way to ensure accountability on the vendor, on any third parties that you've got helping to implement, to really break it up into the pieces that, look, I've got a vision, but phase one of my vision is this. Let's make sure that we address that before looking at phase 2 or 3 or 4. So
I totally agree. We totally see that with the companies we're helping to implement is keeping up their enthusiasm and energy to make it to phase 2 and make it to phase 3 so they get the value of what they thought they bought. Our last topic here in the technology section, I was thinking to myself, nothing like ending on a high note, is what are the roadblocks to being able to undertake more technology projects? And unsurprisingly, I'm sure to anybody on the call, the roadblock most often mentioned by 61% of the respondents was budget. We'll talk about that, but let me also just draw your attention to the frequency with which lack of support seems also to be an issue. So that is broken up in a couple of categories. You might have a lack of support from management or from other departments like IT or from subsidiaries or lines of business. But, if you add all of those lack of supports together, that becomes a big issue as well. And both of these things, I think, come together, tying back to a point Justin mentioned earlier, the point that Treasury is not typically a purchasing agent for very large dollar items. A Treasury management system, a full-size Treasury management system might be the single largest dollar item that a Treasury purchases. And in the course of your career as a Treasury professional, you may only do 1 or 2 implementations of systems like this. So it's not the buying process, the budgeting and internal selling process and building support for your idea is not necessarily an area that we get a lot of training on in business school or a lot of practice in actual Treasury operations. So I think it points to the fact that Treasury has to get better at figuring out how to sell the benefits of these solutions in order to more successfully commandeer the budget and support for them. And interestingly, the numbers on this question were almost identical regardless of the size of the company or the geographic location. So everybody in Treasury seems to have the same problems. Doesn't mean that they're not surmountable, but I think if we know what the primary difficulty is, we can be more deliberate about addressing it. And, you know, just very quick, it's not an easy question to address, that budget issue, but I would say that we said earlier that the Treasury group that makes the case just based on operational savings or the value of man-hours that don't have to be expended on manual spreadsheet activities, it's tougher to make a sell there than if you're focusing on the strategic aspects of the technology. So things like an ability to get 100% visibility of cash and risk exposures very, very quickly. The opportunity for system-based controls, which are far better than process controls, and audit, like system controls, a whole lot better. The opportunity for better payment audit trails. The opportunity to avoid the problems that are inherent in spreadsheets. A tool that lets us enforce consistency of process reporting and controls over all of our Treasury nodes, not only corporate Treasury, but our regional Treasury people and our Treasury centers. So those kind of strategic advantages, if you can build a case that acknowledges those, we have seen more success than simply focusing on saving 3.5 hours a day.
The other one that I've seen Kathy used well is also the what is the value of not having a restatement. That tends to get the CFO's attention. Other ways that we've seen organizations, and in addition to, you're right, you're spot on, looking at more of the strategic value, other ways that we've seen Treasury organizations put forward an effective business case is essentially using a catalyst, and a catalyst could be a regulatory change, a change in leadership as a way to spark that process and getting the interest in building out an ROI analysis. So,
and there's nothing like having your software be sunset. So
yeah.
you have a really old system that's getting sunset, boy, your back is against the wall. You can make a good case on that. Okay, so to our conclusions page then.
Yeah, so I mean, we've covered a lot today, and hopefully you found it as interesting and insightful as certainly I have and we have going through the analysis of the data. Some of the major themes around the initial portion of our discussion is that we live in a very dynamic environment, and we operate in a very dynamic environment, and that we're hit with from at least 3 ways. One is the internal pains that we feel as a result of working within a larger ecosystem, and that could come down to budgetary constraints, that could come down to staffing, that could come down to the family dynamics that you live with as being part of a larger organization. Another element is the markets. We have been impacted by a number of market forces, and will continue to do so. Whether that be again that the Chinese currency, the euro currency, falling off. Whether that be us stepping into, I don't know if September's it, but looking at a raising rate environment, and just the different monetary policies that the Fed will put in place, whether that be the decrease in liquidity on balance sheet, that certainly does affect us. The regulatory environment hasn't gotten much. It doesn't seem to be cooling down at all. So Dodd-Frank is still something that's a lot more questions than answers, and questions around when enforcement will come into play, how that enforcement will look. Basel III, I assume that many of you on this call, if you haven't been visited by a banker near you, then you likely will. Or it means that they've assessed you behind the curtain and feel that the share of wallet is good. The various regional elements, so you've got IFRS 9, 13, and then you've got I didn't mention it, but in the U.S. the money market fund reform and the impact on finding a nice liquid, highly liquid place to put an easy to manage place to put your short-term investments. SEPA certainly in Europe a major concern. So you've got these regional elements that you have to operate under. So while the environment hasn't, we're in this environment. What we have found is that the strategic value that Treasury can play is a significant one, especially when looked at outside of just the traditional cash forecasting, but looking at more of the how can I add value to the business, as whether that be through M&A, whether that be through funding, whether that be through lower cost of capital, whether that be for higher yield on investment now that we're going into a raising rate environment. So interesting times indeed.
I think, Justin, that there's no question in our minds as Treasury people that the strategic value is there. And when we see the non-core responsibilities that Treasury is starting to assume, when we see hopefully the end of the shrinking trend and a switch to possibly a growth trend in Treasury resources, I think that's kind of evidence that it's being recognized at a more general level. But there's no substitute for regularly reminding management how much value is being added. In consulting, we like to say we tell our customers how happy they are. And I think in Treasury, that's what we need to do. We have to remind management how much value we're creating and how critical some of these things are, the problems that get avoided and the quick responses to questions and concerns when there are global events of one sort or another that now Treasury is equipped to handle and respond to, as opposed to 5 or 7 years ago when it would take you a week to get all the data together. So, okay, better marketing and reminding people what we're doing. And finally, that we're seeing the real maturation of the role of technology in Treasury, a move away from sole reliance on spreadsheets into tools that are far more powerful, better controlled, that give us greater capabilities and efficiency that will let us continue to transform Treasury. So we want to thank you for listening, and we have a few minutes left to take your questions.
So thanks everyone who submitted questions. You can still submit them through the panel, and if we don't get them today, we'll follow up with everyone as well. We have Justin and Kathy's information on the screen. So let's start with the first one. I'll send over to Kathy. We talked a little bit about Basel III requirements. What changes have your corporate clients seen their banks put in place, and what actions should corporate treasurers be taking to prepare?
Okay, thanks, Grace. Well, the answer to this is it varies greatly from company to company. And it can vary according to the type of business you're in, the size of your relationship with your bank, and the particular type of business you're doing with any individual bank. My first counsel would be that the most important tool in assessing how Basel III is going to affect you and your bank relationships is conversation with your banks. You need to be talking with them, and you expect that you will get different answers and comments from different banks because of the points I just mentioned, the type of business you do with them and the level of balances you have with them, probably differs a lot from bank to bank. So you're going to hear different answers, but you need to be in conversation with them to build an understanding of how they are looking at operating versus non-operating balances. And then you need to understand specifically how they're going to look at your balances and what is it that creates or causes your balances to be one or the other, and whether there's anything you can do to change that. Secondly, I would say be alert to the likelihood that they will be, many of your banks may be introducing new deposit products that provide an opportunity to earn interest, but also cause deposits in those products to be classified as good deposits from their point of view. There are certain, if a deposit has certain characteristics, the bank can count it as a favorable deposit. So they're creating products that have exactly those characteristics. So you'll need to be shopping around and understanding some of these new products to see if they fit in your short-term investment scheme. And then especially in the area of, if those of you who may use physical or notional pooling, you'll want to be talking to your provider of those services, because as part of their de-risking activities, there are a couple of banks who've announced that they are exiting those businesses. And if you do pooling and you haven't talked to those banks, that provider bank yet, probably you've heard about it, but on the off chance that you haven't, that's an item you need to make sure you check off your list.
Okay, thanks, Kathy. So we're almost at the top of the hour, so we'll just do one more question, which I'll pass to Justin. So we talked about a lot of the different challenges, but what do you think is really driving these challenges in Treasury?
Yeah, good question. We look at it from how do people come to us? You know, how do they come to Reval to say, look, there's generally a catalyst, and sometimes it is, you know, I'm looking to get off of old technology, but there's generally a driver. Even with that, it's not I'm looking to change. But the biggest, I guess the biggest changes that we see are change of control. So I saw a stat the other day that, you know, M&A or corporate action has been at its highest in over 10 years, and on a rate to outpace past records and number of transactions. So M&A is a huge one, where two companies are coming together. The complexity of the organizations will only increase, and the need for better visibility, better cash visibility, and better risk visibility is a real huge driver to that. You know, globalization. I mean, companies historically were you'd only see companies over a certain turnover rate and assume that they'd be playing on a global stage. But I mean, there are companies that are $50 million in annual revenue that are very much playing on a global stage, and they are exposed to currency risk. They're exposed to supplier risk. They're exposed to commodity risk. And so that's been another driver that we've seen spark conversations and drive people to look at technology as a way to help solve those issues that they're dealing with. And then the last, I think, the feedback that we get is you can't hedge, or you can't plan for what you don't see. And you know, cash visibility has been running through all this, but it's visibility of your exposures across the board. And so having, you know, a consolidated center of truth as to what are your true exposures and how best can you mitigate it. I think people realize that now that hedging with partial visibility could even be more dangerous than not hedging at all if you don't have a complete view of what your exposures are. So yeah, I'd say that globalization, you know, some sort of a corporate action, whether it be M&A or even a spin out, and you know, the centralization effect on managing global corporate risk is probably the three big drivers that bring people to Reval to look at addressing the challenges that they're facing.
Okay. Thanks, Justin. So it looks like we're just out of time, so if anyone submitted questions that we weren't able to get to, we will follow up with you after the webinar. So at this time, I'd like to say thanks again to Justin, Kathy, and our audience members for joining us today. If you'd like to view the presentation slides or a recording of today's event, an email with the recording link and the slides will be distributed next week. This now concludes today's webinar. You may disconnect your lines, and we hope you have a great day.
Thank you, Grace. Thanks, Kathy.